Have you ever just tried to imagine what it's like to have so much money you literally can't count it? For centuries, we've been obsessed with these stories of insane wealth, from ancient emperors to modern tech titans. But these stories, they're not just about fancy lifestyles. They hold some really crucial lessons about how wealth actually works, and maybe more importantly, how its concentration can shape our entire world. Okay, let's dive right in.
It seems like such a simple question, right? But it leads to some incredibly complicated answers. The minute we try to crown the wealthiest individual in all of history, we run into some serious contenders, and each one has a claim that kind of redefines what it even means to be rich. So first up, you've probably heard this name, Mansa Musa. He was the emperor of the Mali Empire, a kingdom that controlled some of the most valuable gold and salt mines on the entire planet at that time. His wealth? Well, it was so vast, people just described it as incomprehensible.
Then you fast forward a bit, and you get figures like John D. Rockefeller. He didn't have gold mines, he had oil, the black gold that was powering a whole new industrial world. His fortune really set the bar for what modern wealth could look like.
And if we go way, way back, what about Augustus Caesar? I mean, his personal wealth was so tangled up with the Roman Empire that after he defeated Cleopatra, he basically added the entire treasury of Egypt to his personal checking account. How do you even put a number on that? This timeline really gives you a sense of the sheer scale of Mansa Musa's wealth. So his pilgrimage to Mecca in 1324, this wasn't just a religious trip, it was a global economic earthquake. Just picture it, a caravan with 60,000 people and camels carrying literal tons of pure gold. When he passed through Cairo, he just gave so much of it away that he single-handedly caused massive inflation. It took the region more than a decade to recover. His wealth was so great he could crash an entire economy just by being generous.
But as fun as it is to imagine all that, trying to put a dollar figure on these historical fortunes is, like this historical analysis says, a fairly futile task. And the reason it's so futile is that the very idea of wealth has totally changed over time.
This slide illustrates the problem perfectly. Back in Mansa Musa's day, wealth was stuff you could touch: gold, salt, land, owning the trade routes. Today, wealth is way more abstract. It's held in stocks, complex things like financial derivatives, and digital assets that didn't even exist a few decades ago, let alone centuries.
So here's the bottom line. Any direct comparison just completely falls apart. For one thing, calculating inflation over hundreds of years is pure guesswork. A tiny error in your assumption balloons into trillions of dollars. Second, what could a Roman emperor even buy? He couldn't get a smartphone or a flight to space. The whole basket of goods is just different. And maybe the biggest issue, for rulers like Musa and Augustus, was the empire's treasury their money? The line between public and private wealth was so blurry it basically didn't exist, making a net worth pretty meaningless.
So we kind of have to change the question. Instead of getting lost in these historical what-ifs, a much more urgent question pops up. What can the concentration of wealth today tell us about our own economic future, especially looking at 2025?
When we look ahead to 2025, the global economic landscape is, well, it's a minefield, particularly for anyone managing a huge fortune. We're seeing huge shifts like de-dollarization, that's countries moving away from the US dollar. And of course, geopolitical instability is messing up supply chains. Throw in high interest rates, making it expensive to borrow, and even so-called sustainable investing, or ESG, is getting called out for greenwashing. Companies faking how eco-friendly they are. Every single one of these things is a major headwind, creating risk for the whole system.
And that brings us to the real question we're tackling here. It's not about who's the richest. It's about what happens when so much wealth gets crammed into the hands of so few people, especially in such an uncertain time. Does it make our whole system more fragile? To get an answer, we have to look at the data. And there's this major working paper from the World Inequality Lab that did a super deep dive. They looked at 150 years of economic history across 18 countries to see if there's a real link between wealth inequality and financial crises. The big idea they tested is called the inequality crisis nexus. See, for a long time, people studied how a crisis causes more inequality. This paper flips that whole script and asks, can rising inequality actually predict a crisis before it even happens? And the answer from the data is a pretty loud yes.
The study found that when the wealth share of the top 1% goes up by a noticeable amount, statisticians would call it a standard deviation, it's linked to a 3 to 8 percentage point increase in the probability of a financial crisis. That is a huge, statistically significant early warning signal.
So how does this actually happen? Well, the paper lays out a pretty clear path. As wealth gets concentrated at the very top, that giant pool of money has to go somewhere to get a return. The wealthiest investors are often more willing to take on risks, so they pour money into riskier assets. This flood of cash inflates prices, and that's how you get bubbles in things like stocks or real estate. And eventually, as we all know too well, bubbles burst, and that triggers a wider financial crisis.
Now, what's really crucial to get here is the timing. This isn't something that happens overnight. The research shows that while a credit boom might signal danger for the next year, a rise in wealth concentration is more like a slow-burning fuse. It takes a couple of years for that instability to really build up in the system, which makes it a really powerful but often ignored early warning.
This all might feel a little abstract, right? Like a problem for economists and billionaires to worry about. But what does the share of wealth held by the top 1% actually have to do with the rest of us? It has everything to do with us. Because when those asset bubbles pop, they don't just hurt the portfolios of the ultra-wealthy. No way. They trigger systemic financial crises that lead to deep recessions, massive job losses, and economic instability that hits every single person from Main Street to Wall Street.
And that really brings us to our final critical question. The data shows this clear link between rising wealth concentration and the risk of a financial collapse. So as wealth gets more and more concentrated today, are we just ignoring one of the clearest early warning signals for the next big financial crisis?